Good afternoon, everybody. Jerry Lynch, JFL Total Wealth Management. We're very happy to have this special webinar on debunking the mysteries surrounding the cryptocurrencies and what role, if any, should it be playing in your portfolio. For over a year now, many of you have been watching the news on a daily basis and seeing the stories dealing with Bitcoin and other types of cryptocurrencies and its volatility and how it's making millionaires and billionaires and so forth. Now, anytime anybody's investing, or if a vendor is coming into my office and they're saying you should get involved with these types of investments, the question I always ask them is, how do I make money? And equally important is, how do I lose money in these types of investments? So as we go through there, I think there's a couple of common themes that we've seen in the media over the past year. First, so what is crypto and how is it basically being used in society today? I just don't understand the hype that's associated with this thing, the volatility, the amount of press that it's getting. And then should you be using this as part of your overall portfolio? Now, we're very happy today to have a special guest from Dimensional Funds. For those of you that are not familiar with Dimensional plays a core role in our actively managed strategies. We've been working with them for quite a while now. The company was started in 1981 by a gentleman named David Booth. And if you're not familiar with the name, if you know anybody who goes to the Chicago School of Business, it is named after David Booth. 3 of the original board members are Nobel laureates. 2 of the 3 are still on the board of directors. The other person passed away. When you have Nobel laureates staying on your board for 40 years, it tells you that they are committed to the company and to the process. Now, specifically today, we have Dr. Philipp Meyer-Brauns. He's the Vice President and Head of Investment Solutions Analytics for Dimensional Funds, and his background is amazing. He has a PhD in economics from the Freie Universität in Berlin in cooperation of the Max Planck Society, which is a nonprofit organization in Germany based on science. In addition, he has a Bachelor's of Science in Mathematics and Economics and has a Master's in Science in Econometrics and Mathematical Economics from the London School of Economics and Political Science. Philip, welcome to our broadcast today, and thank you for being here.
It's great to be here. Thanks, Jerry. I'm looking forward to the next hour or so, touching on some of the things you mentioned, cryptocurrency.
Well, we'll have some fun, that's for sure. So I guess the first thing is that, if you present to me a stock, let's just say Apple computers, I can understand the value of Apple. They make watches, they make computers, they make phones, they make a lot of them. They have profit at the end of the day, and their company should continue to grow on a very systematic basis. When I take a look at Bitcoin, it's a lot different, and I don't really understand, or many people don't understand, how the fundamentals work, what gives them value, what gives them such volatility in the prices. How does this thing work versus the normal securities that most people are familiar with?
Yeah, I think that's a great starting point. It's a great question. And I think if you are thinking about potentially putting money or investing into Bitcoin, that's probably something that you have to have a good answer to. And I'll tell you why I think that it's a little bit difficult to have a good answer to this one, a satisfying answer. Because as you mentioned, Jerry, it's a little bit different for something like Bitcoin, right? There are no cash flows in particular. So how is a typical security, a stock, a bond priced? Well, essentially you're handing over money today when you buy a stock, when you buy a bond, in exchange for a set of expected cash flows in the future. With the bond, it's very easy. You know exactly what the promised cash flows actually are. And if you tie today's price to that set of cash flows, that gives you the yield, the return. With a stock, it's not as visible as far as what the actual cash flows are, but you are acquiring a claim, a residual claim on the company's profit. So for Apple, right? So once all the workers are paid and everybody's paid, the remaining profit, which obviously for Apple is quite a bit, is split among the shareholders in the end. So it's clear what you're paying for and on expectation what you're getting, and what brings that expectation back to the present. So that set of expected cash flows, $1,000 over the next X years are today worth X dollars. That's the discount rate. That's the expected return. So we know very clearly what the compensation is, and that tends to be higher if the risk is higher and so forth, right? So very clear what's going on. With Bitcoin, it doesn't work like that, right? So there are no expected cash flows. If you own a Bitcoin today, or any other cryptocurrency for that matter, you're going to still own a Bitcoin 10 years from now. So there are no cash flows. So in some ways, there is no fundamental value in the sense of being able to tie this to future expected cash flows. So very different. Which leaves us with two questions, right? What about other instances where that may be the case? Bitcoin is not the only thing that doesn't have cash flows. You know, you think about a commodity, right, or currency, that's where Bitcoin would tend to fall into those camps. Although there too are some differences where with commodities, you know, you think about a barrel of oil or maybe gold that you could use for jewelry, right? So typically commodities have a use value, right? Whether that's using the barrel of oil to, I don't know, ultimately drive my car or produce something, or whether that's using gold to create jewelry that we all like, you know, and so forth. With Bitcoin, obviously that's not there. So there isn't, it's a commodity in a sense that it doesn't have cash flows, but there isn't really a use value. So I'd caveat that as well. And then maybe lastly, after all, it's called a cryptocurrency, right? Cash is something that doesn't produce cash flows. So if I hold $1 today, same as with Bitcoin, I'll still have $1 10 years from now. There's no cash flows. I'm not acquiring rights to anything beyond that dollar, which, you know, has a purpose. Of course, we all have a liquidity or cash portion in our portfolio to meet essentially short-term needs, right? You know, pay my rent at the end of the month, buy my groceries, pay for the kids' school, whatever it may be. You need cash, but maybe we'll get into this a little bit there. Here, the problem obviously is the enormous volatility. So Bitcoin just went down 10% yesterday. So if you were holding some of it to pay your rent at the end of the month, you know, you better keep stocking up, right? Because it just lost 10% of its value. So it doesn't really have that, what economists like to call a short-term store of value property, right? That if I save, I don't know, $1,000 today because I need to pay my rent at the end of the month, and you know, likewise for other expenses, I know that if I put that $1,000 aside, it'll still be able to buy, you know, rent or whatever I want to buy at the end of the month. With crypto, that's not the case, right? Given the volatility.
So Philip, I guess my question is then what gives it the value?
Yeah, exactly. So then why is it at, you know, 30,000 as of late, or maybe 60,000 a little bit more recently? And you know, for that one, I think ultimately the price is just where supply and demand meet, right? Let's begin maybe with that. So in the end, we know from many other financial markets, whether that's stock markets, whether that's bond markets, that it's a bit of a futile exercise to see a price and then question it, right? As you mentioned, some of the Nobel laureates we work with, Professor Farmer would be, I think, you know, pretty strong on that, where in some ways prices where supply and demand meet, and it's pretty much impossible to prove that a particular price is too high or too low. Nevertheless, obviously, what's not really satisfactory about that answer is that, you know, why is there demand, right? We know there's supply, somebody invented it, put it out there, but why is there demand? And I think there, again, nobody can prove, and there's probably more than one source of demand. Some, I think, ideas that have been at least floated are that early on, obviously, and including up to this day, you know, certain transactions, illicit transactions, activities that, you know, in some ways, at least if you're criminal, you'd rather not do in the official banking system, were facilitated by cryptocurrencies, right? So that's a source of demand that, you know, obviously is not great, it's illegal, right? But it's nevertheless a source of demand. There's obviously a group of, let's say, enthusiasts, both for the technology as well as from a, you know, a monetary policy type camp that sees in this something that will be adopted much more broadly in the future. And based on that expectation of future demand is buying in today. So these are, I think, some of the sources of where, you know, if you take it at face value, people could be coming from if they're buying into it. So you can't use it like a barrel of oil today. You can't use it as cash, but you can maybe use it for certain transactions that, you know, are of an illicit nature, let's say, or you assume that maybe in the future this will be part of the financial system for, you know, sometimes reasonable, at least expectations, such as making payments cheaper, right? So that was the original idea. So instead of, you know, when you go to the grocery store or buy anything, going through the credit card vendor that charges 3%, you know, and the bank charging money and so forth, you do a peer-to-peer transaction and cut out the middleman. Right? So today that's actually problematic because the Bitcoin system is so congested that one transaction, it varies, but it's currently at about $50. So doesn't quite work for many transactions, especially smaller ones. But that was the initial idea. So, to some extent, there could be an expectation in there that people say, well, maybe if somebody solves the cost problem so that it's no longer $50, it could be interesting for a vendor to say, well, you know what? If you pay with crypto, I don't pay the 3% to the credit card company. Why don't we split the difference? You get a 1.5% discount and I have a higher profit. So these are some of the ideas. Obviously, it's hard to distinguish from a pipe dream at this point.
Okay.
But, yeah.
Well, I guess the question is, this was created on a computer. What's to stop me from creating Jerry dollars, which would be high in demand and would create huge value for everybody? And then if I owe somebody money, I could be paying them with Jerry dollars. Is that really just getting back to what you were talking about with supply and demand? If there was a demand for Jerry dollars, then it could potentially be a viable currency. And if there wasn't, then it wouldn't. Is that kind of the point I'm
Yeah,
getting?
I mean, and I think that's where some of the uncertainty comes from, right? In fact, so I've mentioned Bitcoin now a lot because it was the first and it's by far the biggest individual of these cryptocurrencies, but there are more than 4,000 different cryptocurrencies out there. So, the idea of, oh, can't I just set up my own, Jerry dollars, Philipp dollars, is actually what happened in many different cases, right? Including cases where Dogecoin is the one that has been fairly prominent. Projects or currencies were, literally set up as a joke to, be some kind of a satire perhaps on the whole concept, and then took off, and many others obviously faltered. So yeah, I mean, the software is open, right? So you and I could indeed go and start our own. I think what the proponents of something like Bimbi Bitcoin would say is that there's obviously a network effect that's at play here, right? So the optimal number of currencies for payment purposes in the end is one, right? So that you do away with the inefficiency of having to convert from, the dollar to the euro to the yen, or in the Bitcoin and crypto world, the Bitcoin to Ether to others. So that, if we all start our own currency, we're probably not gonna, if I start my own Philipp dollar and I show up at Tesla, who recently they said they were gonna accept Bitcoin for purchasing their cars, and then they retracted it, actually, complicated story. But if I came up with my own cryptocurrency, they would probably say, well, you just made that up, right? There is no value behind that. So I think it's a kind of a fragile balance between supply and demand. And you mentioned it's a purely digital system. So there are obviously a lot of users, and there are about $600 billion in current market value in Bitcoin. But, I don't think it's safe to say that, maybe the demand will go to zero at some point there too. It could, right? If another thing comes along that solves these issues better.
So what's the difference between cryptocurrencies and digital currencies?
Yeah, that's a good, I think, just definition to clear up, because in some ways it sounds very similar, right? It sounds like it could be the same thing. And there are a lot of similarities. I think maybe let's start with digital currencies and just the notion of electronic money, right? So our financial lives today are already predominantly facilitated in an electronic manner, right? So if I go to the store, or I book a trip, or I order something on Amazon, whatever I may be doing with my currency, that's already, in almost all cases these days, digital or electronic, right? So very rarely do I actually go out and buy something with dollar bills, with coins. I can still do that, of course, but more commonly for the economy at large, especially in developed nations like the US, like Europe, that's already happening electronically. So that's not the new part about the cryptocurrencies. That's just a digital idea. The new part about the cryptocurrencies is to say there has to be record keeping, right? So again, if I use my credit card and buy groceries, it's electronic, but the record keeping is still done by a centralized, trusted third party, right? So the money doesn't go from me directly to the grocery store. It goes from me to, let's say, the credit company, their bank, my bank, the grocery store's bank. So there's a couple of financial intermediaries that maintain the ledger like they've done for hundreds of years, right? Somebody needs to say, Philipp just spent his money, so he doesn't have that money anymore, so it's out of his account. Otherwise, you have what's called double spending, right? Otherwise, I could buy a Tesla and then turn around and buy another one, and then buy another one, right? So that record keeping is currently done in a centralized fashion by JP Morgan, by Bank of America, by American Express, whoever it may be, financial intermediaries. The new idea with crypto is to say, well, we still need record keeping. You have to prevent double spending. Otherwise, there's no use, right, of the system. Instead of having a central party do it, let's do that in a decentralized fashion. So have a computer network that's spread all over the globe, that's not owned by anybody, whether it's a company or any country in particular, but does this record-keeping job in a decentralized manner, right? So we no longer need JP Morgan in between. If I go buy my groceries, once again, that simple example with Bitcoin, which obviously right now I can't do that yet, but that's the vision or the pipe dream, depending on where you stand. Then when I do that, it would still leave my account, but the verification, so looking that I actually have the money, and once I've spent it, subtracting it from my account, is done by a decentralized computer network, which means we do not have to pay the financial intermediaries, which means your assets, theory at least, don't have to stop on borders, right? So international payments become a lot easier. So that's kind of the idea, to do it in a decentralized fashion instead of having these financial third parties, financial intermediaries in between.
So one of the things, again, I have friends of mine that are in finance and they deal with, let's say currency hedging. I'm, let's say, doing a deal with Canada and I have a $10 billion deal with Canada. One of the reasons why I would hedge a currency is that I want to make sure that if their currency drops, that I have something that kind of replaces a loss. Would something like this have an impact on that type of business, or are these apples and oranges?
Yeah, so that goes back a little bit to what I said earlier about the optimal number of currencies being one, right? So just from an economic efficiency point of view, and obviously leaving just history and politics and all of that out, it would be ideal if Canada and the US had the same currency, just for transactions purpose, right? Because then you wouldn't need currency hedging, right? So the problem here is, if I do a deal with Canada and the Canadian dollar depreciates, if I'm selling something to them, let's say, I'm getting back less than I was planning on maybe for my business. So I need to put on a hedge. So again, I need to pay a counterparty to, I don't know, Goldman Sachs or someone to do that hedging transaction with me, and they have to balance it on their books and so forth. So it's a bit of an inefficiency. I think in the world that some of the enthusiasts anticipate would be, we all do business in this global monetary standard, and the dollar to some extent is a version of that, just not complete in a sense that all countries have it, right? But usually every major commodity, oil and so forth, everything's traded in dollars, right? So with that kind of efficiency improvement in mind, but with one global monetary standard, I think the advantage that some of the enthusiasts see would be to say, well, Canadians, they're doing their business in Bitcoin, we're doing our business in Bitcoin, so there is no exchange rate risk. It's just the same currency. That's, but obviously we're extremely far away, and if that will ever happen is, I think, anyone's guess.
Yeah, that'll be interesting. So can you give me some examples of how cryptocurrencies are used and digital currencies are being used today? And I guess the question I would have is, let's say I had a Bitcoin that's worth, let's say, $30,000 today, and I go in and I buy a car that's $25,000. How do they give me change?
Yeah, so I think the good starting point here is just to acknowledge that adoption is very minimal at this point, right? So you have, again, some pioneers, you could maybe call them, or just folks trying something different, like Tesla. So they had announced that you could start buying their cars with Bitcoin, then actually withdrew that. So nobody actually knows how it would have worked out. What you can buy today on occasion is very similar to how you might buy something with the US dollar, right? So if you have a Bitcoin balance in your wallet, which is essentially a version of a bank account, and you buy something, you would just transfer that amount. So in your example, the Bitcoin, many other currencies too, just like the dollar, it's divisible, right? So you have you don't have to always pay one Bitcoin, and if that's too much for what you're buying, you have a problem. That's not necessarily the case, because you have, for Bitcoin in particular, about 100 or exactly 100 million subunits. So similar to, if a dollar is too much for what you're trying to buy with it, right, you would maybe pay 75 cents or something like that, right? And so because it's all digital, basically you never face the problem of giving more money than it's worth and then having to get change, right? Because it's digital, you would just transfer the exact amount that's needed to buy the car, let's say, right? The 25,000 in your example.
So is a digital currency, is like my debit card considered a digital currency, PayPal, or some of the the things that we're using on a pretty systematic basis, would that count right now as being digital?
Yeah, I think it depends a little bit on who you ask, to be honest. I think in some ways the answer is yes, because it's electronically facilitated, right? So you use your card, you don't have to carry any change with you to buy anything. That's electronic, so it has the same properties as any digital currency would have, including the cryptocurrencies that we talked about potentially. What comes into play though, and maybe we'll cover that in a little bit more detail here also in a moment, is there are some ideas of making the whole basis for the currency of a country digital, right? So that's this idea of central bank issued digital currencies. And China is a pioneer. There are some other countries that starting to road test this, the Bahamas, Sweden. The US is saying, Fed Governor Paul, that they're actively researching this. Right, so what's happening now is say the US dollar. A lot of the transaction happens on an electronic level, right? So again, you use your credit card, right? You use a computer to transfer money. So you're not actually oftentimes using coins and bills, but the underlying money is still the money in circulation, right? The underlying money is still not something that's issued on a server operated by the central bank, by the Fed, right? The underlying money is the same money that that's always been there in the US in some ways. We're just now layering on top electronic transaction system. And here the idea with the digital native currency in some ways issued by the central bank would be to say the whole monetary system is operated on a server, or it runs on a server operated by the central bank. And so there is no more coins, right? So it's all done. The ledger, again, you need a ledger, right? A record keeping system. The idea here would be that would be run by the central bank of a country.
So I guess, how do you see this thing changing over the next 2 to 5 years? So like, how is this going to come into modern America or the world, or what restrictions do you see happening on it so that the governments feel more comfortable with it?
Yeah, I mean, it's a fast-moving space for sure. So I think making any predictions is bound to lead to failure in some ways. But I think there are interesting developments going on, right? So we just saw the Bitcoin price in particular, measured in dollars, cut in half, right? From about $65,000 earlier this year to just over $30,000. Last I checked before this webcast, who knows? It's fast moving, right? So I think the extreme volatility, that's really, orders of magnitude higher than even equity volatility, which is already very high, just reflects a lot of uncertainty. And the uncertainty is around future demand. So, is this all a pipe dream, and 10 years from now we'll laugh about it, right? I think it's a realistic view on the space as well. To regulatory uncertainty, right? So the IRS, keeps basically saying in very clear terms that they're going to look at the space, increasing attention. So it's not the Wild West anymore, right? In the US, it's treated as property, which means capital gains apply. Some countries have gone as far as banning Bitcoin, so banning the whole thing altogether. Turkey did that recently. Others, just recently, El Salvador, small American nation, said it would be Bitcoin might become an alternative legal tender in their country. So it's this vast range of just notions and opinions out there. And I think it seems that we have to separate maybe a little bit between the efficiency gains that we can have, right? Like if you have a digital currency and if that's operated by a central bank, let's say, that can often be better than what we have now, this chain of financial intermediaries that make everything probably more costly than it would have to be in an age where you're really just moving data. From the notion that Bitcoin, which is totally independent of any government, will replace all the currencies that we know. I think that's a little bit unlikely, but anybody's telling. Yeah. But I think in the short term, just a lot of uncertainty, right, coming from governments across the world. The US has been so far, I would say, somewhat neutral. So they haven't really fought Bitcoin much or supported it much, for instance. Other countries have been on either end of that, but I think the next 2 to 5 years will probably show which way the government involvement goes, whether to some kind of adoption or to a more negative stance of trying to clamp down on this activity.
So again, Colonial Pipeline paid 75 Bitcoins to reopen after a ransomware attack. I just heard yesterday that the government found a way, and I don't understand how, to get back these coins or recover this money. The thing I think a lot of people are scared about is it seems like it's the currency of the underground, terrorist organizations and so forth. And I guess if the purity of it is the fact that I could do transactions direct without government involvement or people knowing about it, and this happened where they were able to recover this money, how does that impact this type of currency?
Yeah, it's a very interesting case, and I think also something that raised a lot of the Colonial hack raised a lot of attention from governments, right? Because it's basically a national security threat. So what happened, maybe as a recap for people on the call, right? So a group of hackers essentially attacked or infiltrated the networks of Colonial Pipeline, which is a company that runs a pipeline that transports gasoline from the Gulf to New Jersey, I believe. So key national security infrastructure. The pipeline was shut down for 6 days. I think you had shortages, gas shortages and so forth even. And the hackers basically said, pay us, 75 Bitcoin, so about $4.5 million for us to release the system again. And even though the US government, I believe, discourages such payments, right? Like it's basically a terrorist act, more or less. Mm-hmm. The company felt that their best way forward was to actually pay, so they did pay. And then interestingly, I think this was announced just yesterday. So really, I think evidence for how fast moving this space is. The US government actually came out and said, well, they recovered, as you mentioned, Jerry, a good chunk, I think more than half of 64, I believe, Bitcoins of the total 75 of the ransom. And I think at first glance, that's obviously, it's good news, right? Because I think ultimately, even if some of the use cases like ransomware, or many years ago, there was a phenomenon with a marketplace of sorts called Silk Road, where again, the idea was made as an anonymous means of payment, Bitcoin, and it can be used to buy and sell things that you'd rather not do, or buy and sell with, let's say, official money, drugs, guns, where it would be otherwise prohibited, and so forth. And that too was shut down by the government, and many of the Bitcoins retrieved. So I think it's a good thing that in some ways the government has been able to clamp down on this, right? Because otherwise, obviously, very negative outcomes and probably not a stable foundation. So even if there were some use cases, this was my earlier point, based on this, obviously that's pretty limited, and it's just illegal and bad activity, right? So I think if that's what it's for, it would probably be a tiny, tiny niche that would hopefully be, clamped down on the government as much as possible. Now, from the, let's say, cryptocurrency camp, what surprised many was the ability of the government to come in and retrieve the ransom in the first place. Because many thought it might be the case that Bitcoin is totally anonymous, right, and not accessible. So again, as opposed to a bank account with JP Morgan, where I say if the government says that those assets need to be frozen, they will be frozen, right, with the appropriate court order and so forth. Many people thought that that's not possible with Bitcoin, but that's actually not true. So it is actually not an anonymous system, which I think is a good thing, because again, the basis of something cannot be just illegal activity. It's a bad thing. You can trace because it's a public ledger, right? So you and I, Jerry, we could, go in, look at every single transaction and trace the very transactions that were made, those 75 Bitcoins. And we could see where they were before, we could see where they are now, and so forth. So it's traceable. And then the interesting question for, I think, the more technology-focused folks on this topic was, well, how could they get in though? So the one thing is to say we trace the transactions through the various different wallets, but how can you grab it, right? How can you retrieve it? And for that, obviously, I don't have any intelligence. I just know what is in the media on the case. Basically, two options would be that either the government did find access to, or got access to, the private keys. So private key is something very important in this cryptocurrency world. It's what allows you, and only you, as the owner of the key, to access Bitcoins. So it could be the case, for example, that the criminals were monitored and communicated their private keys one way or another. and those were obtained, right? We don't know. It was not, I think, published how it was done. The other option was that, I don't know if that was the case here, but what you sometimes see is obviously people like that want to ultimately convert away from Bitcoin into currency they can actually use, to our earlier point, US dollars and so forth. And for that, you have to use an exchange, right? You have to go to Coinbase, is the one that recently got a lot of attention. I don't know if they did that here, but that's again a case where you would then have a third party in there, so Coinbase in particular. If they were to receive the Bitcoin payment with an order to convert it to US dollars for the person that holds that account, that would be another point of entry where law enforcement could come in and say, well, this is actually sourced from an illicit transaction, so let's not go ahead with that. I don't know what was the case here. It's not public information.
Well, it's very interesting. You had some excellent slides that I would like for you to kind of go through, and I think that will
absolutely
some questions as well too.
Yeah, absolutely. Let me bring these up here. Hope they are visible. And some of what's on these slides we already covered in our conversation. Maybe I can do for those where that's the case, just do a quick, just a recap, right, of the essentials here. So this is where we started today, Jerry, right? This notion of, okay, for Apple, I know I'm signing up for a residual claim on their profits. If I buy a bond, I know I'm signing up for a set of coupons and final payment. And that's what gives us the market value here on the left as expected future cash flows discounted back to the present. Discount rate, again, that's your expected return. So it's very clear as an equity investor, as a bond investor, where the expected return comes from. Not the case with Bitcoin. There are no expected future cash flows. So again, that led us to commodities and currencies as maybe cousins of sorts, but then also some important differences there. I wanted to just, we haven't focused much on that, but I think it's clear as part of the unspoken context of why people are interested in this, just what the price has done, historically. And this is here as of the end of March, so end of last quarter, where indeed the Bitcoin price was at about $60,000. And I mentioned earlier, it was about cut in half over since then. So now we are down here at $30,000, which I think drives home again that just the extreme volatility in that space is something that you need to know about if you consider it for any type of investing over the long haul. Although of course here, even at 30,000, it's clear that this enormous rise has indeed been a storied rise, as we put it here. So probably also a good chunk of the attention that Bitcoin and other cryptocurrencies have been getting is just due to the hype that type of return or price appreciation has brought. I wanted to, and this is something we haven't really talked about much. I mean, we talked about, okay, why is it worth anything, or should it really be worth anything, supply and demand? But if you were to take it at face value and just think about, is this something that could have a role in an investment portfolio? I think a good starting point for that is just to look at its overall value, the overall value, market value for Bitcoin, for cryptocurrencies, and compare that to the overall investable opportunity set. So what else could you be investing in? Stocks, bonds in particular, because there's always an opportunity cost, right? For every dollar that I put in Bitcoin, even before I determine whether or not it's a good idea to put it in Bitcoin, the dollar has to come from somewhere. So every dollar I'm putting in cryptocurrencies, I'm not putting in equities, I'm not putting in bonds. So I'm missing out on that return in favor of putting it somewhere else. And the question is always, okay, how much, if any, should I put in a particular asset? And a good starting point for that is what we have here. It's typically just the overall weight in the market. And for Bitcoin, despite the rise that we saw on the previous slide, I think it's extremely important with all the newspaper headlines and all the attention on the space to keep in mind that it's tiny, right? So we have here, again, as of the end of March, so really, in some ways already outdated, which I think, if anything, supports the story of extreme volatility and the doubts that I would suggest people should have as it relates to this being a potential investment. But 1.1 trillion, 1.1 US dollar trillion, as of the end of March. Today, 600 billion. So again, about half. Cryptos as a whole, about 1.8 trillion. But now compare that to the global stock market, MSCI All Country World IMI Index, a very common broad market benchmark, 70 trillion. 70 trillion. And the global bond market, coincidence here, but nevertheless, another 70 trillion, right? So together, 140 trillion versus 1 trillion, or today really 0.6 trillion. So less than 1% for Bitcoin here, for example, right, of the overall opportunity set. So I think it's important to keep in mind that even though there's been a lot of attention and there've been a lot of headlines, it's still only a tiny fraction of the overall market. And if you must own any or know someone who would like to own some, I think it's important to keep in mind it should be a tiny, tiny sliver. I would argue a zero sliver, but if you go beyond that, a tiny sliver of the overall portfolio.
Now, one of the things I'm always concerned about is that what if this thing just implodes? So what I'm seeing out of this is 1% of the global economy, and if it implodes, it would have an impact, but it's not like a third of the value of the world just goes away. Am I correct in that assumption?
Yeah, I mean, I think that's I think you're right. In fact, we just saw. I mean, again, I'm showing you the 1.1. It just went down to 600 billion. So it was about cut in half over the space of 2 months. But if the stock market, if this number would have been cut in half over the last 2 months, we would probably be talking about something else today, right? So, which in some ways also shows that the systemic importance of something like Bitcoin is minimal, right? So in the end, it seems like a lot of speculators probably lost a lot of money from the 600 or so billion that went away over the course of 2 months. But beyond that, it doesn't seem to be the case that, I don't know, banks were in this in an over-leveraged manner like we had in 08 and 09 for the stock market. So it's, as far as I can tell from just following the space quite closely, nothing really happened. People lost a lot of money, but that's money they put in, so they should be prepared to lose it as well. But it's not like the stock market or the bond market, which is cut in half. They're very different.
So I got a question from Adam in Florida, a serious question. If adoption of blockchain ledgers grows, what will the inherent increase in value of the currency within that chain? So I guess as people feel more comfortable with the ledger system, I would assume that's going to be very positive for this type of currency.
Yeah, of course. I think that goes back to supply and demand and where the price sits, right? So if for one reason or another, people start seeing more use value or expect more adoption going forward, that should increase demand. And the supply, at least for Bitcoin, is growing slowly, is ultimately capped though at 21 million Bitcoin. That should lead to a higher price, right? I think the key question here is that we don't really have a good answer to is, will that demand go up? Because I think you can only maintain the expectation of a new monetary standard for the future for a certain amount of time, right? So Bitcoin's only been around for 10 years, just over 10 years, launched in 2009, invented in 2008. So I think it remains anybody's guess. But if another 10 years from now, we still don't actually see any real world applications, I think the vision of this being a replacement for currencies as we know them will probably grow, a little bit more faint with every day that doesn't actually become reality. So I think, I don't know either, but I think just projecting out demand and adoption is not where we are currently. It will really depend on how the space develops.
So who are the biggest players in this market? I think it fits in well with your next slide.
Yeah, let's take a look at the landscape. Once again, there's more than 4,000 different cryptocurrencies today. So a lot of, Philipp and Jerry coins out there without much or any value to them. I'm showing you here the top 10 just for the market share. Again, as of the end of March, but Bitcoin down a little bit since then, but not much changed because the whole space went down. Bitcoin, obviously here up top, the orange line, you see initially was almost 100%. It is the original cryptocurrency. More recently here at about 60%, and as of today, actually closer to just under 50%, but clearly the dominant player. So it's in some ways a very top-heavy space as we put it here. And then we have a couple of contenders that may be familiar to some on the call as well. The most prominent probably Ether, which is a cryptocurrency that's based on the Ethereum network that you see in greenish blue here at about 10%. Then other is that whole other pool of 25% or so. And then you see here, so Bitcoin's number 1, Ether is number 2, and then these are the other 8 in the top 10. You see almost at 0, right? So it's there are 4,000 out there, but really most of them don't carry a lot of value. And some have also appeared and already disappeared in this fairly young space, but faded from attention. So I think it's probably fair to say that there will be some kind of consolidation. If you look at 4,000 players active in the space today, not all of these are built to survive and certainly not to thrive in the long term. There is some differentiation. So Ethereum, the network, for example, enables a lot of additional functionality, let's say, that Bitcoin does not. So it's not to say that out of 4,000 there will only be one, but probably some anticipated consolidation is fair to assume, I think.
Well, I'm really pushing for those Jerry coins, just personally. But I guess the other thing I would have is one of the things I talk about with our clients are non-correlated assets. Something zigs, something zags. Bonds and stocks have a tendency to work in different types of markets. Now, this is definitely a non-correlated asset to a lot of different asset classes. You'd mentioned it's down 50% year to date. And we have reasonable returns in the stock market. Like, what does this thing correlate with?
Yeah, I mean, because of its extreme volatility and almost erratic price behavior, if you study just the movements. In fact, we have one more here. Maybe we can tie it a little bit to that shows one example of that, and then I'll get into the broader notion of correlated versus uncorrelated. Obviously, we love financial market data at Dimensional, so we study all the various aspects of it in quite a bit of detail. But here's one idea where sometimes Bitcoin is brought in as some kind of a inflation hedge is the idea, right? So big topic lately. And here you see very well that, at least based on the data we have, that's not the case at all, right? You see here the teal line, Bitcoin moving around, right, on the order of 20, 30, 40% in both directions. So it's volatility. Obviously, over time it's gone up, but it's volatility. And then you see here inflation, on this scale anyway, pretty much flat, right? So there is no way in which Bitcoin movements month on month are correlated with inflation, which is what you would need for an inflation hedge. And so sometimes thrown in there is the notion that maybe this is something that can help you outpace inflation for the long run. But then we're back to our expected return conversation that we had earlier, where it's not clear that there is a positive expected return because there aren't any cash flows. So kind of thin ice there. And I think something similar is true, Jerry, if you compare Bitcoin in correlation terms to other asset classes as well, right? So on a month-on-month basis, it's fairly uncorrelated to equities, right? So we just heard over the last 2 months, it's been down by 50%. The stock market has been all right, right? Up a little bit, down a little bit, depending on how you measure it, but certainly nothing of the sort that we've seen for Bitcoin. We had in 2020 a case where obviously markets came down quite a bit, equity markets in March, and so did Bitcoin. So there, interestingly, some people tried to make the case that this was a general risk-off kind of movement away from both equities and even the cryptocurrency space as well. But if we look at a month-on-month basis, it's uncorrelated. But that's not all there is to an asset you want, right? So in an ideal world, you want, positive expected return assets that have low correlations. Even for bonds, you hope that, if you put them alongside your equities, the negative or low correlation can help buffer the overall volatility a little bit. But that's only valid because bonds have a much lower volatility, right? So there's really no use in an uncorrelated asset that moves at 10 times the volatility of equities, let's say, right? So the property that you need is both for just one portfolio purpose, which is dampening overall volatility, right? Risk management. What you need is ideally both a low volatility of the risk management asset, like bonds have, and a low or negative, ideally, correlation between that and other assets like equities in your portfolio. If you just have something that's non-correlated, but it moves around wildly, then the non-correlation property is kind of worthless.
I have a question from Peter. Can you talk a little bit about mining of Bitcoins? How does that work?
So mining of Bitcoin is essentially the activity that does the record-keeping job, right? Recall from our earlier discussion, in any payments network or monetary network, financial transactions network, you need a record keeper, right? You need someone that says, Philip just bought a Tesla, let's say, with his Bitcoin. So the money's now outside of his wallet and is with, Elon Musk's wallet or Tesla's wallet, so that there's no double spending. Again, in a traditional system, that's what the bank does. That's what the credit card company does. Here, what does it is this decentralized network, and specifically to the question, that's what the miners do, right? So what the miners do is basically they facilitate transactions, right? So if I want to buy something with Bitcoin, or I want to send some Bitcoin to you, Jerry, or whatever it may be, right? That transaction is projected into the pool of possible transactions. And the miner's job is to essentially consolidate, so do the record keeping, consolidate these transactions into what's called a block. So many will be familiar with the word blockchain, which is just a different word for this ledger that has been built upon. About every 10 minutes, there's a new block, and every block is essentially a basket of transactions. So if I buy the Tesla and my Bitcoin goes to Tesla, that's one transaction, and the miner would go and say, okay, we'll put that one in the next block, we'll put that one in the next block, and then it's officially part of the Bitcoin network, and the transaction is publicly visible and cannot be reversed. And why do the miners do that? Right? It's not a charity that they do it. They do it because with every new block that's created, there is what's called a block reward, which means for the service of putting together all the transactions and verifying them and so forth, they get awarded Bitcoin. And that's how new Bitcoin gets created. And this will be the case. So right now, every 10 minutes, there's a new block, and the block reward is 6 Bitcoin. So if you are the lucky miner, they compete, right? So it's, you can't you don't have an exclusive right to do that. So there's no central party, but they compete. Maybe we can talk about the energy use that goes along with this competition as well. It's basically a problem-solving competition for the right to put together this next block. If you're the one that wins that right because you solved the mathematical problem, the crypto, that's where that comes from, problem first, then you get awarded 6 Bitcoin, which is $180,000, was twice that a few months ago. And that's how the record keeping is done. So that's what the miners do. It's a little bit abstract, but I tried to keep it at a high level.
So I have one last question because I want to be respectful of your time. So when I'm looking at this, I'm taking a look at my clients, and I'm taking a look at the risk that's associated with this. Even if I see a conservative portfolio, and let's just say it's 40% stock, the 40% is 100% stock, and within there you might have some areas of the stock market, international emerging markets, that are rather aggressive. I see this as something being the same thing. I don't think it's for most investors. I think that you have to go into it. I think AMC movie theaters, the CEO came out and said, you could buy our stock, but be willing to lose all your money on it. And that's kind of the same thing here, is that either you're going to make a tremendous amount of money, or you're going to lose a lot within a very short period of time. It's not used as a core holding, but if you have excess cash and you're looking for something that potentially may make a lot of money or lose everything, this may be the place you want to put your money. Is that a kind of a fair statement?
Yeah, I mean, I would say at a maximum, right? Because I think there are very good reasons, very defensible reasons not to touch it at all. And if you think about what do different assets do for you in your portfolio, there's a couple of different roles that different assets play. We touched on that a little bit. So one role is positive expected return, and that's what you have stocks for, maybe corporate bonds for. Very clear purpose. Many of us would like to grow wealth over time, like to save for retirement and so forth. So positive expected return. Bitcoin doesn't have that. No cash flows, no positive expected return. The other goal, of course, that often comes alongside the expected return goal is mitigating uncertainty, right? Uncertainty around future wealth, for example. So for that, typically we do use government bonds, or maybe TIPS, right? Inflation protected government bonds. So again, something that you obviously can't do that with an asset that, loses 50% in 2 months. And this is not the first time. This happens all the time, right? These types of movements. So the idea that this is uncertainty mitigation obviously doesn't compute. And then the third typical purpose, where we usually have a cash or liquidity component in the portfolio, is just that, right? You need cash to, again, we discussed this earlier, meet short-term needs, you know, I don't know, pay the rent, buy the groceries, buy the dishwasher if it breaks down, whatever it may be. And again, the absence of a store of value property, so that enormous volatility, means you can't use it for that either. So this was a very quick rundown, but I think if we think about traditional ways in which we use investments or assets to serve us, right, to meet our needs, to meet our goals, there really isn't a place for crypto or Bitcoin to connect to that. So, and for me as an investor, if I don't see the purpose of an asset, then I don't touch it, right? The reason, you know, the fact that it's gone up exponentially is not really, that's not sufficient reason to invest, right? If it were, you know, we'd all be 100% in AMC or in GameStop or in Tesla, right? But that's, with hindsight, you can always find an asset that would have made you a millionaire. But that's not what investment is about, right? Investing is about a forward-looking asset allocation intended to serve your goals, right? And if we all knew that, you know, in a year or 10 years, this is at $1 million, of course, we're all in, right? But that's not the forward-looking idea that we think is what investing is. And so I think good reasons to stay away altogether. And then maybe to come around also to your question, yes, if for whatever reason you have goals outside of the ones I mentioned, or you determine for you, you know, that this is it, then I think, yeah, exactly, treat it as something extremely speculative, you know, treat it as something that you could lose the whole thing, and think about that what if, right? What would it do to your finances if that were the case? Which again brings us back to probably, I mean, for most of us anyway, a tiny sliver, right? You know, how much of your portfolio could really go to zero without, you know, without meaningfully impacting your life? It should be no bigger than that. I think that needs to be just said very clearly.
Philipp, I just want to thank you. This was awesome. You know, I think for the people that we work with, a lot of what we try to do is, you know, moderate to conservative strategies so that they could retire, they could grow their money in a meaningful way. DFA is a good part of what we're using for our clients, because I like their ideas and their thoughts and so forth. You know, with this type of stuff, you know, there's certain amounts of information we can honestly talk about and feel very confident with. There's a lot of stuff when it comes to taxes, estate planning, where we need high quality people like yourself to kind of come in and fill in the gaps for ourselves and our clients. So I definitely appreciate you and all of the DFA team for, you know, helping us out here, and anything, you know, for everything you did for us today. Thanks again. I really appreciate it. And thank you everybody for listening here today.
Yeah, my pleasure. And thank you as well for everybody who tuned in.